Hi, thank you for watching Digging into China. I'm Dong Shop. If you have not done so already, please subscribe to my channel. Thank you very much. Let's discuss the stock market again today. A notable phenomenon is the contrasting trends between the stock markets in China and the United States. While the US market consistently reaches new high, the Chinese stock market, on the other hand, experiences a continuous decline. We are aware of a fundamental principle. The rise and fall of the stock market are linked to currency issuance. If there is an excessive issuance of currency akin to an overflow, it naturally lifts all assets and the money flows into the stock market. However, this principle does not seem applicable when comparing the stock markets of China and the United States. Despite China having a significantly higher overall money supply than the United States, it doesn't reflect in the performance of the Chinese stock market. The Chinese stock market continues its descent, with both the real estate and the stock market simultaneously declining. This is a notable observation, suggesting that the Chinese economy is indeed gradually approaching a pivotal moment. Today, I will address this topic in two segments. Let's first examine the reasons behind the rise in the US stock market, as there are many aspects worth discussing. Lately, all three major US stocks indices, the Dow Jones, the S&P 500, and the Nasdaq, have recorded widespread gains. These indices demonstrated a significant upward momentum last year, with the Nasdaq leading the way with a remarkable increase of over 46% the past 52 weeks. Why has the Nasdaq seen the most substantial surge? The key factor lies in the enthusiastic interest in artificial intelligence themes. Stocks such as Nvidia, a company frequently discussed among investors, and the so-called Magnificent Seven, encompassing major corporations, have observed evident spikes in their stock prices. Following the fundamental principles and the patterns of technological diffusion, the upcoming year is anticipated to witness a widespread integration of AI technology across diverse industries, making a year of technological diffusion. Consequently, companies primarily focused on hardware may experience a moderation in the pace of their stock price appreciation, while firms in various application-centric sectors are poised for a new round of speculative activity. This perspective resonates with the insights presented in the February issue of Barron's magazine, indicating that the buzz around AI themes in 2024 is expected to persist. In the last quarter, S&P 500 companies mentioned artificial intelligence in their public documents over 530 times, indicating a noticeable increase. This data serves as an indirect indication that the companies across diverse industries are actively investing in research and development to promote the application of AI within their respective sectors. The comprehensive upward trend in the US stock market is closely linked to the fundamental aspects of the US economy. Notably, the US economy demonstrated a favorable trajectory throughout the previous year, with consistent growth in consumer spending since 2022. In the final quarter of the year, the GDP experienced a 3.3% increase, contributing to an annual growth rate of 2.5%. The US unemployment rate has remained largely below 4% for the past 3 years. Therefore, with a foundation of a steadily growing economy, sustained consumer spending, and a resilient job market, the trends in the US stock market are well coordinated with these positive economic indicators. Yet, this data correlation remains superficial. My main focus is on the subsequent aspect, unraveling the deeper layers beneath the surface. The more profound the rationale behind the ascent of the US stock market extends beyond its correlation with US economic data. It is intricately tied to the global restructuring of political and economic dynamics. By scrutinizing the trends in the US stock market, we can uncover insights into the comprehensive shifts within the overarching system that drive these transformations. In addressing this matter, the initial consideration involves the distribution of global liquidity. We are aware that the stock market possesses significant liquidity and functions as a primary global hub for fund inflows. The current upward trend in the US stock market is also fueled by liquidity. So, what type of liquidity is being drawn into the US stock market? Given that the US dollar constitutes nearly 60% of global central bank reserves and serves as a key international reserve currency, it is regarded as a global hard currency. Consequently, as a predominant holder of US dollar assets, the US stock market attracts global liquidity. With the ongoing normalization of interest rates in the United States, coupled with the robust recovery of the country's economic fundamentals, it naturally attracts a greater influx of international capital and liquidity. Another contributing factor is that economic conditions in other parts of the world are more dire compared to the United States. For instance, in emerging markets, the tightening of the US dollar quickly results in the drainage of hard money, causing financial constraints and a scarcity of funds at the financial level. The situation in Europe can be characterized as highly challenging. European Central Bank President Lagarde explicitly mentioned during a meeting that the European economy experienced a period of stagnation in the fourth quarter of the previous year. Simultaneously, the US government's initiatives such as policies promoting industrial revitalization and the reshoring of manufacturing bring less favorable news for the real economies of both Europe and emerging markets. In essence, influenced by both internal and external factors, the economic conditions in the United States seem comparatively more favorable. As a result, US stocks generate a suction effect on international hard money, swiftly drawing away global liquidity. Based on the data, it was observed that in December of the previous year, foreign residents substantially increased their holdings of US long-term securities, with a net purchase totaling $142 billion, primarily driven by individual investors from abroad. According to Morningstar's data, the influx of funds into US long-term funds reached its zenith in the past 3 months. Concurrently, US residents have initiated a decrease in holding foreign long-term securities, opting instead to hold securities within their own country. The preceding explanation sheds light on the suction effect of funds by US stocks. However, a question arises: will the liquidity drawn into the United States linger for the long term, or is it a transient influx? This leads to an important consideration. Behind the short-term suction effect on liquidity, there exists a long-term logic that underpins the sustained prosperity of the United States. This rationale is rooted in extensive realignment of global power dynamics and resource allocation, transitioning from the widespread adjustments of globalization to the restructuring of near-shore trade. Notably, there is a shift in relocating supply chains away from China and Russia, both considered as major sources of instability. This is evident from the US import figures. Currently, Mexico has become the largest exporter to the United States, surpassing China for the first time in the past 2 decades. Last year, the total value of goods exported from Mexico to the US amounted to $475.6 billion, surpassing that of China. The significance of Chinese goods is rapidly diminishing, and this outcome is a result of the global realignment of power dynamics and the supply chain systems. This adjustment has only just begun, and the future comparisons are likely to be even more pronounced. During the ongoing global realignment, the United States continues to possess the largest share of resources, including political, commercial, and social resources, surpassing any other region worldwide. Consequently, the liquidity flowing into the United States is unlikely to swiftly depart in the short term. Looking ahead to the medium and the long term, these funds are anticipated to stay within the US economy as they must closely align with the abundance of resource. Money is inherently linked to resources, and the resources closely follow power. In the allocation of funds and the liquidity, there exists a fundamental connection to the distribution of power and the resources. These sets of relationships are highly intertwined. To summarize briefly, the short-term surge in U.S. investment market is a consequence of the tightening monetary policy, representing the redistribution of global liquidity. In the process of liquidity distribution, the United States has exerted a suction effect on global capital. This effect is rooted in the broader realignment of global power and resource distribution. As the United States secures a superior position in resources and influence amid an ongoing restructuring of global power dynamics, it is expected that the capital will persist in the U.S. for long-term investment. Concurrently, the continued rise of new economic sectors propels the upward trajectory of the U.S. stock market, shaping the current overall landscape. Turning our attention to China, the official narrative from the Chinese Communist Party emphasizes China's role as a global economic leader, citing the highest economic growth rate worldwide and portraying China's economy as enviable to all nations. However, in contrast, the actual performance of China's stock market tells a different story, characterized by continuous decline and widespread discontent among stock market investors. This paradoxical situation is noteworthy. The perplexing situation highlights a profound issue. China's stock market is currently failing to fulfill its intended functions and has lost its effectiveness altogether. This breakdown in functionality indicates a shift in China's political and economic landscape towards a completely different phase. In this new phase, there are uncertainties regarding whether the stock market can still play a crucial role. Furthermore, the future existence of China's stock market itself raises questions. Let's explore this aspect in more detail. For viewers residing in China, the first significant event of the Chinese New Year in 2024 was the official release of impressive economic data, showcasing a considerable lead in various economic indicators. According to an article in the People's Daily, China reported a 5.2% economic growth rate for 2023, and its contribution to the global economy exceeded 30%, positioning it as the engine of the world economy, at least according to official statements. However, concurrently, China's stock market has been consistently on a decline, creating a noticeable contrast between the positive economic indicators and a downward trend in stocks. Let's briefly analyze the reasoning behind this incongruity. Let's start by examining China's interest rate policy. It's widely acknowledged that in recent years, the Chinese government has consistently moved in the direction of lowering interest rates. On February 20th of this year, there was another round of interest rate cuts, specifically reducing the 5-year loan rate. This action by the Chinese Communist Party serves as a continual signal to the market, indicating a release of liquidity. Simultaneously, the Chinese government has engaged in substantial money printing, especially post-pandemic. China's broad money supply to GDP ratio has surpassed 220%, a ratio notably higher than that of the United States. This suggests that at its core, the Chinese market possesses significant resources. It's just that people are hesitant to invest these resources. Another factor is the overall downturn in China's real estate sector. With the defaults of major real estate firms such as Evergrande, there is a prevailing hesitancy to continue investing in real estate throughout China. There was a previous notion that an excess of funds in China was flowing into real estate, leaving the stock market largely ignored. Now, with the cooling of the real estate market, one would logically expect a substantial movement of funds from real estate to the stock market, thereby elevating stock market valuations. However, this expected shift has not materialized. Hence, following regular logic, all these factors should be advantageous for the Chinese stock market. Moreover, in theory, given China's superior GDP growth rate and various economic indicators compared to the United States, the stock market should witness a substantial surge. This surge should even outpace the US stock market. However, the reality is entirely different. What could be the underlying reason? The explanation is quite straightforward, echoing that I previously mentioned about the US stock market. The three primary factors are the global distribution of liquidity, the redistribution of global resource, and emerging economic trends. China lacks each of these crucial elements and finds itself in a clear disadvantage, positioned as a marginalized country that is being excluded. As mentioned earlier, money follows resource and power. Presently, China lacks significant resources, control over the global system, and leadership. Additionally, it doesn't possess robust technological research and development capabilities. Consequently, liquidity doesn't naturally gravitate towards China. Instead, there is a panicked outflow from China towards the United States. Therefore, the economic data presented by the Chinese Communist Party, regardless of how creatively spun, essentially remains self-declared and cannot obscure the prevailing trend of global economic restructuring. In the realm of international funds, the current Chinese stock market lacks any appeal. Now let's delve into the internal dynamics. As previously mentioned, China possesses substantial internal resources. By analyzing the M2 balance, we find that from 2022 to 2023, China's broad money supply increased by approximately 54.5 trillion yuan. In the same time frame, the United States experienced a contrast with a decrease of $495 billion in its broad money supply. While the US adopted a policy of tightening monetary measures and reducing its balance sheet, resulting in a stock market upswing, China continued on a path of lowering interest rates and extending credit. This in turn led to a decline in the stock market, a reduction in the consumer price index, and a downturn in public investment sentiment and overall contraction. Essentially, China is currently grappling with a scenario combining deflation and a stock market crisis. The current outcomes are a result of forcefully injecting into the market. If these injections were to halt, describing the scenario as undergoing a sudden collapse would not be an exaggeration. So, who holds the liquidity and the market chips within China? Currently, the significant players in this regard are individuals within state-owned groups and institutions that can secure credit from state-owned banks. These individuals are far from naive. In fact, they are quite savvy. They possess a keen understanding of the current economic landscape, leading them to be cautious about investing in highly volatile stock market or in Chinese industries with currently limited returns. For this group, the most prudent action is to make the most of the remaining time to swiftly appropriate the state-owned assets and subsequently transfer their wealth. These individuals can be regarded as key players in the domain of market liquidity. As for individual investors and stockholders in China, these individuals are currently hesitant to both spend and invest. Their only recourse is to keep their money in banks as a temporary measure to secure their financial stability. The overall structure of the Chinese economy has undergone a profound shift compared to the past. The so-called private economy has effectively withdrawn, replaced by the state-owned system, and there is a potential for further replacement by people's communes in the future. State-owned enterprises, central enterprises, and institutions resembling people's communes cannot be classified as modern businesses because their organizational and operational methods do not follow market logic or the logic of conventional enterprise. Instead, they more closely resemble government departments. It's common knowledge that publicly traded companies are responsible to their shareholders, while government departments are accountable upwards to higher authorities. The accountability systems of these two entities are fundamentally different. If a company's accountability system also transitions to being responsible upwards, where the lower level is answerable to the higher level, the company would no longer be obligated to answer to its shareholders. In such a scenario, the entire stock market loses its purpose because companies have essentially evolved into extensions of the government. Examining the economic history of humanity, a robust stock market has always been comprised of numerous exceptional companies and modern enterprises. These entities are characterized by their innovative ethos, advanced managerial proficiency, and substantial capabilities in research and development. There is no historical instance of a successful stock market solely composed of government entities. Hence, if China no longer hosts, in the true sense, modern companies, there may be no compelling reason to maintain the institution of a stock market in the country. During Deng Xiaoping's Southern Tour speech, he advocated for the bold exploration of various economic development approaches, even suggesting that socialist countries could experiment with the stock markets and, if unsuccessful, could consider shutting them down. From the outset, closing down the stock market was considered a viable option because China's stock market was envisioned as a functional market. The decision to retain or shut it down depended on its ability to contribute to socialist development. Therefore, China's approach to the stock market has been clear and appropriately positioned. For the Xi Jinping regime, the stock market holds little significance, and hence it should be closed, a move that seems inevitable. The closure, prohibition, or sealing of China's stock market is only a matter of time. Thank you for watching. Please leave a comment and subscribe to my channel. Just click the subscribe button right here. I'll see you again shortly. Until then, be well.